Nick Hodge here with Digest Publishing, sitting down with the Economic Ninja.
Hey, everybody.
Last time he was interviewing me, we were talking about precious metals. This time he said he wanted to talk about real estate. So
Yes.
I don't do a lot of real estate. I own a house. I own a second house that I'm making to an office, and I own some REITs. But I know you've been putting out some morning videos about real estate. So what's up?
REITs are sort of a four-letter word with me, quite frankly. Well, I guess they literally are. But no, are you ready to own another 100 homes? That's the big question. Because what's coming in the real estate market is going to be so much worse than what happened in 2008. I can't even begin to describe it. But I guess we could start beginning to describe it with the massive mortgage rate hike, and that we're going to see that much, much higher, anywhere between 8 and 10%, sometime between November and this next spring.
And so you think rates are going to continue to go up based on the Fed raising rates, based on the
Absolutely. So it's very easy to figure out that the Federal Reserve, when banks want to loan money, they either loan it to people or they can put it on loan to the Fed. And the Federal Reserve is very safe. It's very secure. It's solid income right now. And the Federal Reserve says that they want to see the Fed funds rate up around 4% near the first of the year. Well, think about it. If a bank wants to make a decision, if they want to take risk and loan to somebody where they think the housing market's actually starting to tilt, go backwards, we're going to start declining in prices, you would want much more interest for your, some more bang for your buck. And actually what we're seeing too is mortgage companies are asking for points now. They want stellar credit for any good rate. And I mean, what's good in this environment? We literally saw mortgage rates double.
6%, yeah.
Yeah, 6.25 right now. So, and right now to sit there and pay that plus a point or two, buyers just aren't there for that.
So what does it mean for me as an investor? What does it mean for Joe the plumber who wants to either sell his house or buy a house? What's the ninja telling people to do?
Ironically, I think Joe the plumber is in a better position than a lot of people of wealth. And the reason why is because people with wealth usually want other people to manage their money. It's too much money. It's too much work. I want to go vacation. So I'm going to put it with a fund manager. I'm going to go buy REITs. I'm going to do things like that, where you only see just a fraction of the profit because everybody's got their hands in it. Where Joe the plumber could go out and buy himself during this next downfall when the prices are rock bottom and the mortgage rates are super high. That's when you want to buy. And I'm calling for 20+% mortgage rates because when it turns and the rates start coming down, that's when you refi. Well, Joe the plumber can actually buy a duplex, a fourplex, rent out 2-3 units, and then enjoy the tax benefits that come along with that. Not only the appreciation when it comes back or returns, but also the tax benefits.
You think this is a nationwide thing? You think certain markets are insulated? Like
100%
Spokane with me and my partners in Austin, where the markets have been sort of booming, right? You think it's across the board?
So let's bring back the famous words of Ben Bernanke in 2006, when the mortgage-backed security fiasco actually started in mid-2005, and he was addressing the nation. He said on CNBC to Maria Bartiromo, when she says, "Is there a problem with the mortgage-backed securities? Do you think how the housing market is going to start to fall?" And he said, if I can get it right, well, I don't think that I understand your reasoning or your premise here, because we have already taken care of it. And by the way, real estate can't fall all throughout the nation at the same time. Well, we already found out he was 100% dead wrong. And the reason why people don't realize that real estate fell was because in 2003 to 2005, the Federal Reserve started the dot plot plan and started raising rates 25 basis points almost every other month until they hit around an ironic number, 2.25%. And that is when the federal funds rate hit 2.25%. We started seeing all of this start to unwind. It's because of the sheer amount of debt in the nation right now when it comes to mortgages. That's where most people hold all of their wealth. That is the greatest wealth effect there is. And actually, it's been proven that when stocks are up and they have that wealth effect, it's not as strong. It doesn't initiate so much buying from the public, whereas when there's a wealth effect from real estate. So when that turns, it takes everything down with it. It's just a big snowball.
You got these people that have taken out equity in their houses. They can see that, technically disappear or go down. I see the Zestimate I get on my house has gone down the past couple of months. So should we sell if we're trying to sell our house? And should we be waiting to buy if we're looking to deploy capital?
So if you only have one house, you should never sell. Why? Because you have to live somewhere. You're going to spend your money somewhere. And that's what's really interesting about real estate. Most people don't understand that real estate is only worth what the average person can pay in a payment. And it usually sits between 1/3 and 2/3 of the average income, the take-home income. So the thing is real estate value will go down as mortgage rates go up. And then when mortgage rates go down, real estate value goes up. And so the point is, the payment's always the same. It always sits between 1 and 2/3 of the average income of any given locality. So my thing is, if you have a house, why would you sell it? You need to live somewhere. Why not enjoy the tax benefits and the security of knowing that you're putting something away for you, for your future? Hopefully you pay it off. But look to go and find investment deals when this thing turns.
So no pivot from the Fed.
Oh gosh, no. You know what's interesting? So I think the Fed will pivot when we see another 20% correction in the markets. But I think we've got a little bit of ways to go. I think we honestly got about 8 to 12 weeks till we see that. And I do believe it's going to come before the first of the year because a Fed funds rate of 4%. I mean, real estate sales have completely collapsed since June, since mortgage rates hit over 5. To think that they're going to be touching 7 and the next 8%, we will have no sales.
Brace for some pain, he says, right?
And that's a really good thing. He's telling you the truth. And the thing is we want to turn pain, like what I'm doing on my channel. I want to turn pain into gain. But the only way you can do that is with patience. And that's what most people don't have in this world is patience.
Well, we'll try to teach them. Thanks for stopping by. It was good bumping into you here at Beaver Creek.
Thanks, man. Appreciate it.
You want to snap?
Yeah. Now.